All right, welcome to This Explainer. Today, we're going to put on our institutional researcher hats to look past all the daily AI hype and really dissect the mechanics driving one of the most talked about valuations in market history, NVIDIA. We're drawing directly from Policy Alpha Research's May 2026 Deep Research Series report, aptly titled NVIDIA at the Tollgate. Look, if you're here, you already know AI is completely changing the world. But today, we're going to dive into the actual structural numbers driving this whole phenomenon. Let's get right into it. $215.9 billion. Let that number just sink in for a second. To truly grasp where we are right now, we have to look at the explosive revenue jump this company has pulled off. Back in fiscal year 2023, NVIDIA's annual revenue was $27 billion. By fiscal year 2026, it skyrocketed to $215.9 billion. We are literally witnessing a financial transformation on a scale that is almost historically unprecedented. But to understand how the market is actually treating this massive growth, we need an entirely new mental model. You see, we have to stop thinking of NVIDIA as just another semiconductor stock. That framework is completely outdated. Instead, we need to start analyzing it as the AI infrastructure pricing proxy. It has become the central toll gate for the entire global AI capital expenditure cycle. When you look at NVIDIA's valuation today, what you're actually looking at is a forward-looking financial bet, a bet on exactly how long, how profitably, and how uninterruptedly the entire global AI build-out is going to continue, because right now, every major player has to pay the toll.
So here's our roadmap for today's explainer. First, we'll look at NVIDIA as a pricing proxy for AI. Then we'll do a reality check on its market valuation and the optimism baked into it. Number 3, we're going to map out the core structural risks, and finally we'll weigh their massive moat against some upcoming growth challenges.
Section 1. Pricing Proxy for AI. AI Infrastructure Pricing Daddy. Let's break down the financial transformation that elevated NVIDIA to this proxy status.
We already touched on the sheer, mind-blowing scale of their top-line growth, right? Going from $27 billion to nearly $216 billion in just a few short years. But what is truly fascinating is what happened underneath that top-line revenue. Over that exact same period, their operating margins didn't just hold steady, they expanded massively, from 15.6% to over 60%. That means not only is the volume of cars passing through this AI tollgate exploding, but the toll itself has become incredibly profitable to collect.
And you know what all that margin expansion translates into? Pure unadulterated cash. The free cash flow they generated rose to an astonishing $96.7 billion annual proxy level by FY 2026, and we saw $50.3 billion in operating cash flow in just the first quarter of FY 2027 alone. I mean, that is just staggering. To put that into perspective, this cash generation literally eclipses the annual free cash flow of almost every single company in the S&P 500, combined with a few left over to spare. This is what cements their tollgate status. They aren't just selling picks and shovels. They own the only hardware store in town, and it's generating historic levels of cash.
But honestly, this next detail is the one that really carries massive analytical weight. NVIDIA issued a Q2 FY 2027 guidance of $91 billion for a single quarter. But here's the kicker. That guidance explicitly excludes China data center compute revenue. Think about that for a second. NVIDIA's engine is running so incredibly hot on non-China hyperscaler demand, sovereign AI programs, and general enterprise deployment that they are guiding near $100 billion quarterly, while their historically largest market remains completely off the table.
Moving right along to Section 2, Market Valuation and Optimism. 市场估值与乐观预期. Because the question isn't whether NVIDIA is a great company. It obviously is. The real question is what the current stock price actually demands of the future.
Let's look objectively at a valuation reality check provided by the Policy Alpha model. If we compare the base case discounted cash flow midpoint, which is basically a strict mathematical estimate of the company's intrinsic value, it sits at $191.80 per share. But the current market trading price? That's at $215.33. That implies a premium of roughly 12% over the base case. Now, is this gap wide enough to scream bubble? No, not necessarily. But it decisively proves that the market is already pricing in a highly optimistic, completely uninterrupted growth scenario. The market isn't waiting around to see if things go perfectly. They are already paying for perfection.
And as this quote from the report perfectly points out, the burden of proof is on the bull case to continue delivering. Right now, NVIDIA is trading at roughly 32 times forward free cash flow. That means every single dollar of annual free cash flow is priced at $32 of enterprise value. At a multiple like that, there is virtually zero room for error. You either need continued explosive cash flow growth or that multiple is inevitably going to compress over time. Pure excitement alone simply cannot sustain these current levels forever.
Which brings us to Section 3, Core Structural Risks. 核心结构性风险. If the market is demanding absolute perfection, we really need to map out what could potentially disrupt this optimistic baseline.
Here is the institutional risk map. We've got 4 primary structural risks to keep our eyes on: hyperscaler capital expenditure correlation, China export controls, custom silicon bargaining power, and compute efficiency breakthroughs. And I want to stress something super important here. The primary risk is not that artificial intelligence demand just suddenly disappears overnight. The real danger is that the underlying structure of that demand changes a lot faster than the market currently expects it to.
Let's anchor this risk discussion with a pretty shocking data point: 54%. That is the percentage of Q1 FY 2027 revenue coming from just their top 3 direct hyperscaler customers. We're talking about giants like Microsoft, Google, Amazon, and Meta. If things go wrong here, a concentration event wouldn't just look like one customer gently pulling back. The massive structural risk is multiple hyperscalers slowing their capital expenditure, their giant budgets for new equipment, all at the exact same time. If they even tap the brakes, NVIDIA is going to feel it immediately. Then we have the regulatory supply chain variable. Just look at the whole H2O chip episode. NVIDIA actually designed this product specifically to comply with existing export control thresholds. But a regulatory change happened faster than the physical supply chain could possibly respond, resulting in a sudden $4.5 billion inventory charge. Looking at this impartially, strictly as a financial variable, policy shifts and export controls are no longer just geopolitical footnotes. They are active, highly volatile modeling variables that can slam a balance sheet overnight. And here is a fascinating technical risk: the DeepSeek mechanism. On one side of the coin, you have brute force hardware scaling, basically just buying more and more GPUs. But on the flip side, you have model efficiency breakthroughs like DeepSeek R1. If software and model architectures suddenly become vastly more efficient, it can quickly put pressure on that whole hardware demand narrative. Think about it. If hyperscalers can get smarter AI without buying nearly as much hardware, the traffic at our Tollgate might slow down organically. This is the big technical blind spot that a lot of retail investors totally miss.
All right, last part. Section 4, Moat and Growth Challenges. 护城河与增长挑战. Let's wrap up by weighing NVIDIA's undeniable competitive advantages against these cyclical headwinds we just talked about.
Now, make no mistake, NVIDIA's moat is incredibly deep and multi-layered. It's not just about having the absolute best GPU. It is their Blackwell and upcoming Rubin architecture, their super-fast proprietary NVLink networking, and their crazy rack-level integration. But the real anchor here, the real superglue, that's CUDA, their 20-year-old software ecosystem. Retraining researchers, porting over massive institutional libraries, and accepting performance uncertainty is simply way too painful and way too expensive for most companies to even consider. The switching costs away from the CUDA ecosystem are practically prohibitive right now. The moat is very real, but as the report notes, its ceiling isn't completely unlimited. Which brings us to a very near-term cyclical challenge: the architecture transition risk. Historically, every single major NVIDIA product cycle has a bumpy transition period. It generally works like this. First, the timelines for the next generation, in this case the Rubin architecture, start to finalize. Second, technically sophisticated hyperscalers realize this and temporarily defer their discretionary purchases of the current Blackwell generation. And third, this creates what we call a Blackwell air pocket, basically a 1 to 2 quarter window of order softness. It's a completely natural cycle, sure, but when you're trading at a 32x multiple, a sudden air pocket like that can cause some major market turbulence. So how do we actually cut through all the quarterly noise? Well, this matrix provides a really actionable, institutional-grade framework of observable signals. For an upgrade signal to actually be confirmed, we need to see consecutive hyperscaler CapEx guidance increases paired with explicit AI revenue growth, and NVIDIA has to hold their gross margins above 75%. On the flip side, downgrade signals arrive a whole lot faster. If a major hyperscaler cites ROI uncertainty and delays their CapEx, or if NVIDIA's gross margins slip below 72%, the downside risk resolves incredibly quickly. That asymmetry is exactly what you need to be watching. Which brings us to our final takeaway today. Look, the opportunity here is absolutely real. NVIDIA is, without a doubt, the highest quality public equity expression of the AI cycle. But the price already knows this. So I want to leave you with this question to critically think about. What must remain true for the current valuation to actually be justified?
Can hyperscaler spending, ultra-high profit margins, perfect product transitions, and fragile geopolitics all flawlessly align to support this premium price? It is a fascinating puzzle. Thank you so much for joining me on this explainer. Keep questioning the consensus out there, and I'll see you next time.